morning. This is Rich Sierra, President of Florida Small Business Legal Center. This is episode number 55 of Business SOS. Very excited that we continue providing great content for business owners and how to really overcome the legal challenges that you will be facing through your business career, business journey. As I begin the show every time, if you want to reach me, you can send me an email to rich@richsierra.com. If you have any questions, any legal questions you'd like me to address at the show regarding your business, I will not mention your name, but I can certainly address the topic in general terms. You can send me an email, and if I select your question, I'll send you a free copy of my book, Business SOS, 8 Common Legal Mistakes Business Owners Make and How to Avoid Them, which is available on Amazon, Barnes & Noble. You can ask for your local bookstores. Also, if you're interested in learning more about my practice, I'm a business, obviously a business attorney with over 20 years experience. You can check out my website at floridasmallbusinesslegalcenter.com. Today's topic is going to be, and I'm kind of going to a theme of 5 things. I'm trying to stay with the theme of 5. Not sure why, but it seems to be, it's kind of catchy just to basically focus on 5 points that I want to give to you in every podcast. So just takeaways. That way, if you take 1 or 2, it's not going to be overwhelming. You're not going to be a long 1-hour podcast, but I want to give you something that you can take with you that morning or afternoon or evening whenever you listen to the show, and something that actually will help you, that nugget that perhaps you did not think about before. Today's topic is going to be 5 things that can go wrong when you're selling your business. I went a few weeks ago, I talked about 5 common mistakes business owners make when they're buying a business. So I wanted to kind of switch the script a little bit and talk about what do you have to do, what mistakes can you do, can you make if you're selling your business and how to avoid them. So I want to focus on that, and I've done many of these transactions in my career, and I see mistakes happening from the buyer side, and I've seen mistakes happening from the seller side. So I want to focus on the seller side for this episode and why it's important. If you're selling your business, you put a lot of work, you have a going concern, and you also are generating revenue. And you say, I'm ready to retire. I'm ready for a change. I think somebody can take this over, have a business that is thriving, is prosperous, and I think that I pay my dues and I want to basically cash out. Nothing wrong with that. So in order for you to do that, you have to prepare. And usually what people do is call a business broker. Business broker tells you, okay, this is kind of a range that you can get for your business. And I ask you for some financials and say, gives you a listing contract like you would receive from a realtor in a residential transaction, and then they post your listings in your business for sale on various websites, and then you begin to get buyers, potential buyers, interested in your business, or other brokers that might have potential buyers as well. Before you do that, there's a preparation that you got to have in mind. It has to take place before you actually begin to list your business for sale. And one of the mistake number 1 that I see happen very often is that there's inadequate pre-due diligence from the part of the seller as to what information to put together in order to send to prospective buyers. And I see that often. So one of the things that you have to do if you're interested in selling your business, you got to obviously understand the reasons why you're selling it, but also understand what the prospective buyer is going to ask of you to provide in order for you to, for him or her be interested in buying your business. So one of the things that I see is from sellers and when I represent buyers is that, okay, we have by the time the buyer contacts me that they want to buy a business, they already have spoken with a broker, or maybe they have a tentative agreement with the seller. There's kind of an email chain that has taken place. There's some tentative commitments, but it's not a very solid commitment. It's like, okay, I'm interested. This is kind of the price that I'll give you, subject to looking at your financials, but we can start with a letter of intent. So from the seller perspective, the first thing that I would recommend is having a non-disclosure agreement to protect the information that you're going to be sharing with that prospective buyer, that information remains confidential and will not be used for any other purpose, but also to the extent that they once the negotiations are over, if the buyer does no longer needs that information, to delete the information or return it back to you. But an NDA, I think, is important to have here to protect both parties as well. But I think from the seller's perspective that I'm focusing today, having an NDA is important, and that's something recommended as well. And an attorney can help you with that. What I consider adequate due diligence or pre-due diligence. So, an example is when a buyer says, and I mentioned this before, that have a due diligence checklist that is fairly comprehensive, and many attorneys don't use that checklist. The ones that I've seen usually have like 5 or 6 items. My list is like 4 pages long. I ask for everything I can ask for. If it's not applicable or the perspective or the seller does not have it, then it's fine. Just say I don't have it or it's not applicable, which is fine. But you certainly want to, when I see sellers, sometimes when we ask for the due diligence, they said, well, my tax returns are not ready. Obviously we ask for 3 to 5 years tax returns depending on the business. Usually 3 years is adequate and usually common and the type of practice that we have. So we ask for 3 years of tax returns, not only your federal tax returns, we also ask for the state tax returns in the case of the business requires sales taxes. And we also ask for the state and for the federal payroll tax returns. That's something that the business owner who's going to be selling that business should have readily available. And often we get the answer, I'm in an extension, it's not ready yet, or we have not filed them. So that is a red flag for me, that if you're in, endless extensions, if you have not filed your tax returns, it kind of makes me wonder whether you actually are paying your payroll taxes. So if you're going to sell your business, make sure that you get with your accountant, your CPA, accountant or CPA, and make sure that your tax returns are available, they're accurate, and to the extent that they can be requested, they can be provided to the prospective buyer, they're available once they sign the LOI. They're available. So, I often see sellers just not having them. And from the buyer's perspective, it kind of creates a little bit of unease, simply because if you're not really having those, you're about to sell your business, you thought about this, it's not something that you thought about it and the next day you decided to do it. You gave it some thought, and you still don't have the documents that most likely are going to be required of you to provide to us. It makes me wonder how you're running that business in the first place. So the buyer has to be excited about buying that business, but needs to have confidence that you're running it correctly in order to go forward with the transaction. The only thing he has is a listing, and he may or may not have spoken to you before. Maybe he spoke to your broker. He doesn't know you as a seller. So you as a seller has to provide confidence to that buyer. Everything is good. Everything that I'm showing to you, it is accurate. And when you step into this business, you're going to make money. You cannot guarantee anything, but it's a business that has been successful, and the investment that you're going to be making in buying this business is going to pay off. But providing those documents are important. So tax returns, every tax return, have it ready. Now, one of the things that we also request is how current are you in your payroll taxes? Have you missing payrolls? Are you basically not submitting the payroll taxes every quarter or with every payroll? That is important. And we also look at, if you don't have a payroll company as a seller, if you're thinking about selling your business, my recommendation is that at some point a year before you start thinking about selling your business, get a payroll company to run your payroll. because it'll have more confidence on the documents that you provide when there's a payroll company behind running your payroll. They have a system in place for the most part. The mistakes will be, you'll have less mistakes when a payroll company does your payroll than when you do it yourself. So it's about, instilling confidence on that buyer that they're buying a good business. And these are truly avoidable mistakes. And I'm focusing on this significantly because it is important and it happens very often. Sales tax returns. So in Florida, if you're in a retail business, most likely you will have to pay some sales taxes. So you'll have to make sure that those sales tax returns are accurate. You're sending the sales taxes to the state on a monthly basis, and you're not withholding those, because you're running short on cash. All that has to be cleaned up. If you don't have that ready and cleaned up, don't put your business for sale yet. Just go ahead and get those things handled, because you will be you're going to be discouraged when buyers will say, I'm not interested. You're going to waste a lot of time, or they're going to significantly drop the purchase price that you want out of that business because you don't have your documents properly prepared and properly submitted. So I just want to focus on that as well. Bank statements. If they ask you for bank statements, provide them. They will be asking you for 2 or 3 years of bank statements. I've had situations where people, for whatever reason, sellers withhold bank statements. Do not know why. They say they're not ready. Or sometimes you have, you do the LOI, then it takes a little bit of time before you do the closing. Then there's a supplement you have to do. You provide the statements up to the LOI, and then you say, I need the statements before the closing to see what happened in the last 3 months while we're doing due diligence. And in some cases, sellers do not want to provide that. Unfortunately, sometimes buyers have closed, and then they suffer the consequences. So provide all the information that you're required to provide, and just be thorough and be transparent, because you'll have to make a representation with your closing documents. The information that you provided is accurate, and it's a true representation of the business. So the more you provide, the better for you, simply because later on you don't want to have an issue that people say you misrepresented something, and I'll deal with quite a bit of litigation on buyers after the fact wanting to sue sellers, saying you made a misrepresentation on the profitability of the business, on the bank statements, tax returns, etc. So just want to make sure that everything is properly documented. Another mistake that the business owners make is improperly valuing the business. And when I hear business owners, I want to sell my business, and so when do you want to sell it for? Said $1 million. I'm just using that as an example. So how do you come up with that number? Oh, my accountant told me. Okay, that's what he thought the business was worth. My advice to you, that depending on the type of business that you have, is to get a number of opinions in terms of the valuation. Business brokers can give you a good idea. They're not business valuators. That's a different conversation that we're going to have. I might bring a business valuator at some point in the podcast to really get a sense of really what, not just the one thing is about what the business is worth. Second conversation to be had is how much can I sell it for? So there are two different conversations here. And you got to find out, you got to make that determination. In my opinion, looking at tax returns is not the proper way to value a business. And many business owners look at the tax returns as a way to value the business, how much it can be sold for, how much you want to offer as the selling price. So depending on the business, they're professional business valuation companies. Yes, you will spend a few $1,000s. That will give you a true value for your business. So that's my recommendation before you come up with numbers, out of the blue. Then get a professional to assist you with that. But I'm not going to go into great detail into how to value the business is not something that we do. Clearly, we have done enough transactions that I know if a business is, have a sense of business is underpriced or overpriced, but that's not something that we do as a practice. And I asked the owner, how do you come up with that number? Is that number what is the basis to come up with that selling price? And if the number's kind of off, I said, you might want to talk to a business evaluator to help you really come up with a true number or range of numbers to make sure that you're getting the most dollars that you can get for your business. Mistake number 3, poorly drafted sales agreements. And not only the sales agreements, the closing documents. And I can spend an hour talking about this because I see this very often, and it is a source of a lot of litigation. The sales agreements have to be clear. The closing documents have to be clear, have to be accurate, have to be properly drafted. On many occasions, sellers wanting to save some money decide to create documents on their own to sell their business. I'm telling you, this is just not a good idea. If you're going to get, tens of thousands of dollars in some cases or hundreds of thousands of dollars for your business, okay, it is worth paying an attorney who has experience doing this to help you draft the proper documents to make sure that nothing comes back to haunt you later on. I see it happen very often. And so that's, the sales agreement is critical. It protects you. It also protects the buyer. But the information in the documents and the obligations within those documents are essential, and the representations that you make in those documents in the sales agreement is very important. And there's a very different distinction between an asset purchase agreement and a stock purchase agreement. And people sometimes confuse both. On a stock purchase agreement, person is buying, you're stepping into your shoes, buying your entity and everything else that happened before that. So the good, bad, and the ugly, they're buying. In some cases, stock purchase agreements make sense. On an asset purchase agreement, they're buying the business, the goodwill, they're buying the business assets, the listings, the name, trademarks, the going concern. They're buying, any type of equipment, they're buying that, but they're not buying the entity itself. It's simply an asset purchase agreement. That's what is transferred. They can run the business. You transfer the lease and they continue, but they don't really take any potential liabilities that you may have with respect to that business. They don't buy that. So that's kind of a short distinction of the two. And I'll give you an example of why it's important to have proper documents listed. One of the things that people overlook in sales agreements, it is the issue of the due diligence. And also with respect to the seller's perspective, the non-competes, what you're obligated to do, and I talked about a few weeks ago that non-compete agreements will be banned by the FTC fairly soon. However, in the context of a business sale, non-compete agreements are still valid. And it's important for you as the seller to know what are your restrictions. Okay, at some point you might want to decide to do something else. You might want to go into the same type of business. But you have to understand that if you are selling your business, very likely you'll have a non-compete of some fashion. And that section is overlooked, and I get emails later on, 2 years later, hey, what does my non-compete include? So it's important to understand that. Also, the representations that you make on that business with respect to any potential liabilities, potential threats of litigation is important to disclose. If you receive that demand letter at some point for some type of potential litigation, whether it's a breach of contract claim or maybe personal injury or whatever the case may be, but it's not in the public records with respect to an actual lawsuit, okay? And you did not disclose that, but then later on that new business owner receives that demand letter and say, hey, I told your business owner, the prior owner, that this was happening. That could be a source for a breach of contract claim. So it is important for an attorney to review those documents with you, the sales agreements with you, to make sure that you're not making a representation that may not be, is not fraudulent, but it could be what is called negligent, okay? Or an omission that you should have said to the buyer, you decided to not include it. And I'll give you an example. Businesses have accounts, have clients. There's a certain, volume that a certain number of customers that you have that you rely upon to be able to keep that business afloat. So say, for example, you're an online retail business and you're selling that online retail business, okay? And you have 3 major suppliers, okay? Say you have Amazon, you have, 3 major distribution systems. You have Amazon, you have Walmart, you might have other ones out there. But say, for example, you receive a letter from Amazon just 30 days before closing that they were about to suspend your account for whatever reason, okay? And that Amazon account represents 50% of the revenue of your business that you're selling to this buyer. And you say, well, that's not going to be a problem. I'm not going to tell them, okay? But that buyer is buying that Amazon account that you're going to be transferring to that buyer. But you didn't say that. But you represent in the sales agreement that the business has been run and there's really nothing has changed from the time of the LOI to the time of closing that will affect the running of the business or materially affect the revenue generation of the business. Then you go ahead and close, you get your money, and then you go ahead and find out, then the new buyer gets a letter from Amazon that kind of suspended. Yet you're already closed and you got your money, but then 50% of the revenue from that buyer will no longer be there because the Amazon shut down that account. That buyer most likely will contact his attorney and say, this is what happened. The attorney is going to sue you individually, most likely, for negligent misrepresentation or fraudulent misrepresentation, and look for a rescission claim or a damages claim. So it's important that when you're selling your business, if anything materially changed, in the business, that you disclose it. Any threat of litigation is disclosed. Any threat of arbitration is disclosed. Any losses that you might have gotten served with are disclosed. A lot of sellers get in trouble, not because of the event happened, it's because they were not disclosed. So that's what my advice to you. You got to disclose it. And that's what's important, to have an attorney assist you with this to make sure that if there's anything that will affect the business, it is properly disclosed and it could be addressed. Another mistake within the issue of sales agreements is, I want to talk about financing the sale a little bit. Sellers sometimes, they put deals together that the buyer does not have the entire amount of cash to buy the business. That, they work out arrangements and said, okay, I'll give you, say it's a $500,000 sale. And I said, I have $350,000 cash. Would you finance $150,000? Seller said, okay, I can, I'll give you a promissory note, say for 2 years, 6% interest. I'm using that as an example. And you go ahead and finance that note. And you get $350,000, and then you basically, at the closing, you give a promissory note, properly executed, properly drafted. You get a security interest in the assets of the business. You get a UCC-1 filed, everything. You get a personal guarantee. You get everything done to protect you as much as you're able to, providing within the documents. Then you find out a few years later, or within 6 months later, that the business owner, the new buyer, is not running the business properly, and then he starts missing payments. and I get the call saying, okay, listen, I have a promissory note. How can I get this money? And I said, well, what guarantees do I have that I'm going to collect this money? My answer to that, and I've mentioned this before, you have no guarantees. If you're financing the business, the only guarantee you have is the money you will have at closing. You have no guarantees that you'll get that money, even if you have a piece of paper. The promissory note is exactly what it means. It's a promise that they will pay. And that payment will be contingent on their willingness to pay and their ability to pay. If they have none of those, you're not going to get your money. Now, you can enforce that note, which will require you to go and get an attorney, and then you have to sue the seller, the buyer in this case, and try to enforce that promissory note. In some cases, you might be successful and get some money. In some cases, you will not. So qualifying, if you're going to lend money to the seller, to the buyer in this case, you have to qualify the buyer as to how are you going to be paid. And you need to have those conversations. Okay, so what if you're not generating money from the business? What guarantees do I have that you're going to pay me? Whether it's another collateral, but you got to have those. You got to basically know that not automatically a promissory note is going to guarantee payment. So you sold that business for $350,000 with the promise that you will get paid the $150,000 later on. But your only guarantees at closing the money you're going to get. So qualifying the buyer, if you're going to lend that money, is very important. Maybe putting additional guarantees, putting the spouse. There are other things you can do, and the attorney can help you with that. Or maybe taking a less risk as well. So there are things that you can probably do to protect yourself. But that's sometimes overlooked. And unfortunately, it has happened often that sellers of a business end up losing that second half of the payment for the failure to do diligence on the buyer. In this case, you're lending money, do due diligence as well. Proof of funds, you have any stocks, you have bonds. Well, what do you have why should I lend you this money? Or you can pay me cash. Another alternative to that, lower the purchase price a little bit, get more cash up front. Okay, that's what I tell my clients. You're going to sell your business, there's no guarantee you're going to get that second half. But I'll tell you what, maybe we can negotiate lowering the purchase price a little bit, get all that money up front. Let's not worry about a promissory note. But those are things that you can talk to your attorney about it, who can put that deal together and help you structure a deal that you're actually going to get paid at. And I'm going to touch very lightly on this one because I'm not an accountant or CPA, but failure to address tax implications. And I'm going to touch upon the asset allocation, the goodwill allocation, and the way I structure and there are tax implications for the seller and the buyer depending on how you allocate, what percentage of the sale, the amount of the purchase price is allocated to the goodwill, how much is allocated to the asset purchase, to the actual equipment or the physical part of the business. So in this case, what I do is say, both of you check with your CPAs, let me know what you want to do. But I do not advise either on what allocation they should have, because that's something that's really more of a tax question, and I prefer the CPAs handle it, and then we can just plug in the numbers into the form. Last but not least is what I call complete transfer of assets and liabilities. Depending if you're purchasing a liability, you're buying a debt, everything has to be transferred. A common mistake that in selling a business that takes place is when sometimes there are lease agreements, and many of them are lease agreements, they're not properly transferred, and then, or their business closes, but then the landlord is not around to transfer the lease. Sometimes there are vehicles that have to be transferred, and they're not transferred at the time of closing. Those are things that have to take place, and then people have to chase you. And so it's important that at the closing of the transaction, that everything that is going to be transferred to the buyer is transferred to the buyer. That is very important. You don't have to have latent mistakes or things that are incomplete later on for something that should have been completed at closing. So just to kind of to recap, the 5 mistakes that we talked about today: inadequate preparation for due diligence, improper evaluation of the business, poorly drafted sales agreements, failure to address the tax implications. That's the goodwill versus goodwill allocation versus asset allocation, and then incomplete transfer of assets, and in some cases liability. Again, selling a business is complex. As I mentioned before, it can be done on a one-page document, which I do not recommend. It could be in a series of other documents. But it's important to have an attorney who has experience doing this help you sell your business to make sure you get the most money for your business when you sell it, and you actually get the money transferred to you when you sell the business. So it's not something that I recommend you go out alone. I think if I can add one more mistake is that sometimes sellers decide to do this on their own, and the buyer and seller, we don't need lawyers for this, we can do it on our own. And one of them inevitably ends up in my office. You end up going to be paying more for the litigation that will follow than for the services that you would have paid I would have handled, in this case, this example, the transaction representing you as a seller. It'll be a lot less costly to represent you as a seller of a business than representing you in an actual litigation. So transactional work is a lot less. It's actually more, it's important. It's a bit, I know people think it's boring, but it's important work. And it's there to protect you. Those documents are there to protect you. You worked through your business very hard for too many years. You want to basically sell it for the most amount of money that you can get. So getting the proper representation, proper team to help you to get the job done is important. So this is good for today. I truly appreciate you listening to me. As I close the show, you can want to send me an email. You have any comments on this podcast? If you still want my due diligence checklist, if you're listening to the first time, I offer that just free of charge. Just send me an email at richsierra.com. If you're interested in learning more about the legal services that we offer, my website is floridasmallbusinesslegalcenter.com. I'm at Facebook at FSB Legal. If you want to watch the video of this podcast, we're at youtube.com/@RichardSierra. We're on X at Rich_Sierra. We're on Instagram at FSB Legal. If you want to give us a call, our number is 866-842-5202. Remember that Business SOS, 8 Common Legal Mistakes Business Owners Make and How to Avoid Them. It's available on Amazon, Barnes & Noble. You can ask for your local bookstores. Remember to, if you like the podcast, follow us. We're in Apple Podcast. We're in Spotify, wherever you enjoy your shows. Appreciate a 5-star review. And if you want to write something, certainly appreciate it as well. Share this with your friends, anybody who might be interested in learning more about the how to navigate the legal challenges as a small business owner. Until next week, this is Rich Sierra. Remember that my goal is to help you succeed.